Hi there again, John Bones with Equity Trust Company. In this segment, we're going to be talking about partnering multiple self-directed IRAs and investment accounts together for a singular real estate transaction. In fact, I'm going to take you through 3 case studies of Equity Trust clients who have partnered with multiple self-directed IRAs, as well as a client who partnered his self-directed IRA with his non-IRA money to buy a property, renovate it, and resell it for a profit. Let's get to the training. So one of the most powerful concepts that we can teach here is how to potentially partner with multiple self-directed IRAs and investment accounts. Now, some of our clients here at Equity Trust Company have referred to their self-directed IRAs and investment accounts as their constellation, if you will, of multiple tax advantage dollars or multiple tax advantage accounts. In fact, a client here at Equity Trust Company has 10 IRAs and investment accounts. He has Roths for himself and his spouse, Coverdell Education Savings Accounts, even health savings accounts, and he partners multiple self-directed accounts for singular real estate transactions. So I want to share with you a few case studies in this short segment. So let's jump into the first case study. The first case study is an example of a client that partnered 3 Coverdell Education Savings Accounts, and his name is Brian, and his first transaction occurred right outside of Nashville, Tennessee. Brian found a vacant lot for sale, and he made an offer at $8,000. And when he made the offer of $8,000, he structured the purchase as not Brian buying the property or his LLC, but rather his 3 children's Coverdell Education Savings Accounts. So as you can see here on the screen, the titling for the contract and then the HUD-1 settlement statement and eventually the deed to the property read Equity Trust Company Custodian, FBO is in for benefit of, his first son's CESA account, undivided interest 50%, and Equity Trust Company Custodian FBO, CESA account number 2, undivided interest 25%, and Equity Trust Company Custodian FBO, CESA account number 3, undivided interest 25%. So it was 50, 25, 25. The capital contribution for the full $8,000 went CESA account number 1, put $4,000 in for the $8,000 investment, therefore 50% equity. CESA account number 2 put in $2,000 for the $8,000, therefore 25% equity. And CESA number 3 put in $2,000 as well, therefore getting 25% equity for the full $8,000 investment. Now, Brian's goal, and this is what he did, was to sell the property as quickly as possible to a real estate developer. So in this instance, he sold the vacant lot, bought it for $8,000, sold it for $60,000. After some closing costs, he netted approximately a $50,000 tax-free profit. That's $50,000 that never hit Brian's 1040 as ordinary income because it was in his children's Coverdell Education Savings Account. And now he can use that $50,000 tax-free for K through 12 education, and eventually if they go to college or some other type of post-secondary school, they can use that money tax-free for those purposes. So great example of partnering 3 Coverdell Education Savings Accounts. So moving on to the next one. The next one here is a client who bought a rental property for $24,000, partnering their 3 Roth IRAs. It was actually a mother, her husband, and then her 19-year-old daughter. And they all used Roth IRAs for this transaction. Bought a rental property for $24,000 in Ohio, and they partnered on the deal a third, a third, a third. So on the titling, they had Equity Trust Company Custodian FBO, the father's name, Roth IRA, undivided interest, 34%. They gave the father's Roth IRA a little bit larger percentage, just 1% higher than the other 2. And Equity Trust Company Custodian FBO, the mother's Roth IRA, undivided interest, 33%, and Equity Trust Company Custodian FBO, the daughter's Roth IRA, undivided interest, 33%. So essentially it was a third, a third, a third. And going forward, all profits and all expenses flowed a third, a third, a third. And in this instance, they have about a 19% return on investment, cash on cash ROI on an annual basis. It comes out to about $4,500 on an annual basis. And so each month when the rental check comes in, it's split 34, 33, 33 into the respective Roth IRAs. If we did the compounding interest calculation on the 19-year-old daughter's Roth IRA, starting with $8,000 as her initial investment, over the course of 20 years, if we apply 19% year over year over year, she'll have over $300,000 accumulated in that Roth IRA, all 100% tax-free, of course. So moving on to the last example, this particular example is a little bit more unique. It's not just partnering multiple self-directed IRAs together, such as multiple CESAs or multiple Roths or CESAs and Roths, so on and so forth. It can also be partnering IRA money with non-IRA money. So in this example, Gary bought a property. The all-in purchase and rehab cost was about $71,500. And the way he structured this transaction is he partnered his IRA as 75% owner and then his non-IRA money as 25% owner. So as you can see on the screen, the titling was as follows: Equity Trust Company Custodian FBO, Gary's Roth IRA undivided interest 75%, and Gary's LLC on title undivided interest 25%. It's very, very important when partnering with disqualified persons, and we have a separate segment on self-directed real estate IRA rules and regulations, but you'll learn that with partnering with disqualified persons, everything must flow proportionately. So whatever the proportionate capital contribution is, all profits and all expenses have to flow accordingly. So in this scenario, after the property was sold, Gary had approximately $25,000 tax-free returned to the Roth IRA. And then the remaining about $8,600 went to Gary's LLC, which of course was taxable. So again, you can see here from these three examples, there's a number of ways in which you can partner multiple self-directed IRAs or investment accounts together, as well as partnering your IRA money with your non-IRA money. Of course, making sure that you're doing everything proportionately and within the guidelines of the rules and regulations set forth by the government. And of course, you could always look up this information on your own through Internal Revenue Code 4975. We also have a separate video specifically on self-directed real estate IRA rules and regulations. We look forward to seeing you on the next segment.